Ashish Gupta joins us, CIO with Axis Mutual Funds. Let's take our conversation forward. Ashish, good morning. Thank you for joining us.
Good morning, Nikunj.
It's a market where bulls cannot put a foot wrong. Is it only liquidity and liquidity and liquidity? Remember in movies there's entertainment, entertainment, entertainment. In markets it's liquidity, liquidity, liquidity.
I think that's probably true. I think we have had liquidity primarily domestic, but I think with what's happening globally, both in terms of growth as well as what is happening to global cost of capital, you are seeing liquidity move into asset classes across the board, right? So I think it's not just India that is hitting the all-time high. US market is pretty much the same. I think you guys were talking about it earlier today. China is also now at a 52-week high. You look at gold. So I think multiple asset classes are feeling this flush of liquidity, and that's what's reflecting in our markets as well now.
So what is the best way to approach a market where you know that the technical aspect, which is liquidity, that is on your side, earnings are decent, and globally there are no macro headwinds? What's the best way to really maximize in this kind of an environment? Some call it Goldilocks, some call it easy, whatever may be the scenario, but it's a setup which if you are there, how do you benefit from it?
Sure. So I think in this kind of environment, our belief is growth will continue to get a premium. Of course, one will have to be mindful of the extent of premium some of the companies and some of the stocks are trading at. But I believe growth will continue to command a premium, both because cost of capital is lower and also, on a relative basis, growth is going to become more hard to come by. As I think several people have highlighted, India continues to stand out in terms of relative growth. In the US also, the rate cuts are happening because there is some moderation in growth that is expected. But even within India, I think we are entering a phase where there is going to be much more differentiation among companies and sectors in terms of the growth outcome. Over the last 4 years since COVID, we have seen a lot of sectors come back, cyclical sectors come back because they were in down cycle. But I think and first quarter results, the June quarter results were actually a good indicator that growth is getting more differentiated across companies. I think that's what investors need to make sure that they are in stocks that have not just delivered growth last couple of years, but next 2, 3, 4 years growth outlook is strong.
Could you outline some themes where valuations are okay in and around historical averages, and for next 2 or 3 years growth could be reasonable, maybe mid-teens? Where are those pockets in this market?
So actually, frankly, there are not too many pockets of very reasonable valuations. And actually, multiples are very anchored around growth expectations. So we all talk about how large, mid, and small cap valuations are relative to each other. But we did another analysis where we looked at companies' valuation in their growth cohorts. So if you put companies where the earnings growth expectation is less than 10%, 10 to 20%, and more than 20%. So companies with earnings growth expectation of less than 10% are on average trading at about 20 times earnings. Companies with earnings growth expectation of 10 to 20 today are trading at about 27 times earnings, and those with more than 20 times growth expectation are today trading at an average of 34 times earnings. So the growth is already getting a large premium. I think some of the themes that we are still positive on, even in this construct, one is consumption and various aspects of consumption. It is related to discretionary consumption, includes automobiles, includes even things like real estate, hospitality. So I think that is the one consumption theme that we have. We continue to like the financial sector, particularly the private sector banks. I think valuations are reasonable. And another important aspect is that supply of new stock in this segment is going to be more modest. We have seen increasing supply in multiple sectors, whether it is from private equity or new IPOs, etc. But in this sector, even supply of paper is going to be limited. The third theme for us really is what is driven by government policies, whether it's towards Make in India, PLI, or on the power, utilities, defense side. So those are the three big themes for us.
Okay. When you say you like banks, is it because they have not participated? Is it because of interest rates coming out? What is the logic here in buying banks? Because if economy slows down, which if it could, because globally things are slowing down, then is it a good idea to buy into banks?
So part of the reason is that you're absolutely right that they have not participated in the last 2 years, despite their profitability improving and being at historic high. Their balance sheets are probably better as a sector than they have been in the last 25 years. In addition, I think the other important factor for us is that there has been a lot of concern about slowdown in banks because of lack of deposit growth. And I think that was more the manifestation of the tight liquidity that the central bank had been running because of concerns on inflation, because of the concerns on global cost of capital. And even as we don't expect meaningful rate cuts this calendar year, we think RBI stance on liquidity is changing, and that will start to feed through into better deposit growth. So I think that will bring back some confidence into the banking sector. Of course, in terms of earnings momentum, we agree with the consensus that earnings momentum for the banking sector will be lower. Uh, Both because margins are coming off a high and credit costs are moving up from uh, 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 below normalized level, right? So I think on both those counts, you will see moderation in earnings growth in the banking sector. But given where the valuations are and given the fact that concerns on deposit growth should ease, given the liquidity support from RBI, I think banks can do well.
Ashish, morning. Wanted to also get your take then as to what the outlook is when it comes to the mid and the small cap indices in terms of the kind of valuations that they are commanding. What's your sense as to where they're headed?
Sure. So I think the way we are looking at the market is really a market cap agnostic. So we are looking at stocks not necessarily just in the buckets of which market cap category they are, but as I mentioned, it is more to do with what is the valuations relative to the growth expectations. And on that basis, across market caps, we find opportunities. Yes, certainly multiples for the mid and small caps is higher than large caps. But if you look or compare multiples across similar growth expectations, then I don't see as much valuation difference between mid, large, and small. So a large cap which has 20% plus earnings growth expectation for next 2 years is also not available at 20 times earnings. So I think on that count, we actually don't find too much differentiation across mid, large, and small. There are select opportunities in each of the segments, and generally speaking, stocks are expensive across all three segments.
Okay, fair enough. That's the view coming in on the broader end of the market. But in the meantime, as well, wanted to also get in your take as to where it is that you're seeing earnings growth picking up. Are there some individual pockets that you believe we could see some incremental earnings growth?
Sure. So I think consumption is one theme that lagged the recovery, particularly the mass consumption segment post-COVID. I think we are seeing a cyclical pickup starting to come there. So over the last 2 years, primarily we were seeing growth only in the top end of the consumption basket. And since the last 4-5 months, we have started to see some degree of signs on broad-based consumption pickup. So even if you look at the automobile sector, it's interesting to know that two-wheeler sales are starting to do better than passenger car sales, right? If we look at FMCG, commentary, we are hearing about rural growth now outpacing urban growth. So I think we are seeing some cyclical uplift in that segment. On IT sector, there is a bit more confidence coming in for some verticals like BFSI, that demand outlook is stable and starting to pick up. But we are not really seeing a broad-based recovery in IT sector growth trend just as yet.
Right. Okay, Ashish, great to have you today on ET Now. Thank you so much for taking the time out and speaking with us.
Thank you. My pleasure.
If you like this video, then like, share and subscribe to ET Now.